Folks, I want to talk about something really important today. No, it's not the latest setup. It's not the latest indicator. No, it's something more important. It's how to protect your account, how to protect your portfolio against huge downside moves. Not only how do you protect your portfolio against huge downside moves, but how you can profit from huge downside moves while the markets are plunging. The markets are down over 400 points the last few days. As a matter of fact, I think we've lost about 900 points over the last few weeks. One of our assets is up over 450%. All right? 460%. Let me show you what I'm talking about. Stocks go up. When they go up, bonds go down. When stocks go down, bonds go up. Here, let me put a little thing here. Stocks, bonds. Stocks go down, bonds go up. It's called flight to quality, okay? Now, what's the difference between virtually every retail investor and professional hedge fund manager? Let me tell you what it is. Every hedge fund manager, every professional trader has a bond position in their portfolio. And they vary this bond position depending on how bullish versus bearish the market is. If the market is super bullish, if the stock market's super bullish, they will decrease the amount of bond position in their portfolio. If the market's getting bearish, they will increase the number of bond positions in their portfolio. And they will regulate this flow, their cluster, their position cluster, based on the market's movement. If the market's super bullish, less bond, market bearish, more bond. The key is this, and this is what you need to understand. Almost no retail traders that I know use the bond in their account, and it's a must. It's mandatory, all right? Now, there's a leveraged bond, so you could really increase your exposure. The ticker symbol is TMF. And what it does is it mirrors TLT. TLT is the long-term bond. And if you look at the price action of ticker symbol TLT, and you can trade TLT at any broker, and if you put it next to the 30-year or the 10-year bond futures contract, they will move virtually tick for tick. So what the TMF is, it's just a leveraged TLT. It takes TLT and multiplies it 3 times. All right? So not only do you get a strong upside when the stock market moves down from the bond, from the TLT, you get 3 times as much when you use the TMF. And you can buy this, you can trade this and buy this with a regular stockbroker. You don't need to go to a commodity broker. You don't need to go to a futures broker. You don't need to go to a currency broker. Now, you're asking yourself, well, the stock market's been bullish, Roger, for 10 years. What do we need this TMF for? Well, let me tell you something. It doesn't matter if the stock market's bullish or bearish. It makes no difference where the stock market is. Anytime stocks reach for the 200-day moving average, this is the stock market, every time they reach for the 200-day, that's the 200-day moving average. Anytime stocks are headed down to reach the 200-day or trade below the 200-day moving average, bonds will rally. Flight to quality. It will never change. Investors, traders, hedge fund managers, they get scared. They liquidate stocks and they put their assets into the bond market. It'll never change. TLT, if you want regular exposure, and if you want turbocharged exposure, TMF. Now, I've got a lot more to talk about this, and we'll get into that in future webinar and classes. Talk soon.